Hello and welcome to Edison TV. Today I'm joined by Trevor Steel, who is Managing Partner and CIO at Baker Steel Capital Managers, the investment manager of Baker Steel Resources Trust. Trevor, many thanks for joining us today.
My pleasure, Miloš. Nice to be with you.
Can you maybe first start by giving us a background to your investment approach for those investors who are less familiar with the trust?
Thank you. Well, I'll just say a quick word about Baker Steel. I think, as you know, we're a specialist resources investment manager. We were established in 2001, so we've been going now for over 20 years, established by myself and my partner, David Baker. And we only invest in the resources sector. We do invest primarily actually in, I guess, in terms of assets under management in listed mining securities. We have a number of public funds that do that. Baker Steel Resources Trust, though, is, I think, arguably the most interesting mandate in that it's the most specialist. It has theoretically the highest alpha generation potential of the funds that we offer. It has a concentrated approach, very bottom-up approach, focused on value. So it will have typically no more than 10 to 15 holdings. And it's focusing on what we'd regard as the highest return part of the resources market, that being private companies, pre-IPO companies, companies which are bringing exciting new assets into development. And so the way that I guess what differentiates the trust from, say, a regular investment in a listed mining equity is that we're really seeking to take the development risk on board and earn an excess return for that. So the earlier stage that we would invest would typically be at the pre-feasibility study stage, where we would make an investment with a view that the asset would successfully be financed and move into production. And associated with that development, we would expect to see up to 4 times multiple in our in the uplift in value for that investment. So that's really the primary source of returns, is what we call riding the development curve. And then the sort of secondary source of return is more the traditional, if you like, commodity price exposure that you would get with a regular investment in a listed mining company.
Thank you. That's very helpful. Now, Futura Resources, the owner of 2 coking coal mines in Australia and one of your major holdings, has recently completed an important milestone by securing the financing for the production launch at the sites. So maybe you could talk us through the earnings potential of the projects.
Yeah, with pleasure. You're right. Futura has achieved a major milestone in September, in that it announced that it had successfully raised 30 million Australian dollars in a convertible bond offering, allied to another 5 million of Australian dollars of other finance. So that package together will see the opening up of the company's Wilton mine, their first project, and the second project, Fairhill, has the company's been offered prepayment finance to get that into production. So we're looking at next year, both of these projects becoming mines, and ramping up next year, doing about 1 million tons of saleable product. And then in 2025, that'll be the first full year of production, with around 2 million tons of saleable product. And these are metallurgical coal assets, I should stress. So the coal is going to the seaborne market for sale. The current spot price for premium coking coal is very healthy. It's about $340 per ton. Our mines will have an operating cost of around about $80 per ton, so a very good margin. The current level of coking coal prices, we don't expect prices to stay this high forever. So when we're looking at valuing these assets, we're using a long-term price of $180 a ton as a long-term fair price. But to answer your question, in terms of what the earnings and EBITDA potential of these assets are, if we look at 2025 as the first full year of production with around 2 million tons of production, the company's forecasting an EBITDA of 90 million Australian dollars for these assets. So, you know, quite a healthy return, given the development cost, as I mentioned, is only around about 35 million Australian. So a quick payback. And the reason for that is that these are open pittable, shallow deposits, and there's very good existing infrastructure. There is a processing plant that Futura has a contract with to process the coal. It's on rail. It's in the heart of the Bowen Basin, which is the premium coking coal producing center globally. So all the infrastructure is there. That's what's kept the capital intensity down so much and should give us such high returns. And sort of just to put that in context, if we look at the value that we're carrying Futura at in BSRT's books, which is about 50 million Australian for the whole company, we own about 25% of the company. You can see that would put Futura on a EV/EBITDA of, you know, about half, about 0.5 times, looking out to 2025. And if you look at comparative listed companies, they're trading on around about 3 to 3.5 times EV/EBITDA. So I think there's good upside potential in the valuation in our books. Obviously, that will be predicated on the successful commissioning and operation of these mines, which we hope will be demonstrated in the first half of next year.
Perfect, thank you. And maybe you can also discuss some other near-term NAV catalysts across your portfolio in terms of, you know, other projects you currently hold.
With pleasure. I'd like to focus on actually our largest holding currently, which is called Cemos, which is a Morocco-based cement producer, which BSRT is the largest investor in. With we hold a convertible as well as some equity, and BSRT was the leading financier of the first cement plant for Cemos, and that plant's been up and running now for 3 years, and it's generating quite a healthy EBITDA. It's a small plant. It's about 250,000 tons per annum of cement production, but it's generating around about 8 to 10 million of EBITDA at the moment, which is a very nice solid platform. But importantly, the company, I'm a member of the board, we've just committed to signed off on the construction of our own clinker manufacturing plant, which will be sited adjacent to the cement processing plant, which will make us vertically integrated. At the moment, we buy clinker in Morocco and process it to make cement, but the price of clinker in Morocco is relatively high. It's a very good cement market. Margins are very good. So what we're doing by making our own clinker, we'll reduce the cost of producing clinker by half, which should, all being well, see the EBITDA from our cement plant go from around 8 to 10 to near 15 million per annum. So that obviously is an important driver looking forward. And in addition to that, last year we acquired a second grinding line, identical to the first, which we have in warehouse at the moment, and that will also be brought on stream over the course of the next 12 to 18 months, which again will be supplied by our own clinker production. So looking out from where we are today, Cemos is generating 8 to 10 million in EBITDA. If we want to look at the sort of gilt edge potential, we might treble that EBITDA by 2026. But I think we'd be happy if we can double that EBITDA towards 20 million. I think it would be a very major driver for the trust, both in terms of valuation of the holding and in terms of future dividend potential, given that we're the largest shareholder with about 33% of the company on a fully diluted basis.
Perfect. And maybe you can also comment on the current, market environment in terms of, well, cost inflation, end market demand, and and funding for junior mining projects across the globe. Thank you.
In a word, bad. You want me to elaborate? But look, it's. I mean, I've been investing in the resources sector for 30 years now, and this is one of the worst times that I can remember in that whole period for junior mining, for development projects in terms of securing finance. The whole market, as we know, is generally risk off, given the higher interest rate environment that we've seen and the geopolitical situation. Things are difficult, so anything that involves risk, i.e., financing mining projects, is more difficult because of that, and so it's a very tough environment. But for that reason, again, very, very pleased to get the Futura financing done. It was difficult in this environment, but I think what it does lead to is other opportunities for a vehicle like ours in terms of, there are a lot of investment opportunities around with companies, seeking finance. So you've got to look at it both ways. But look, I think the other thing is that the trust, given its trading on a significant discount to NAV at the moment, is reflecting the state of the market, and I think that we are where we are. So I think it gives good recovery potential when things get better, which they will. This is a cyclical business.
Great. And finally, you've already touched upon a little bit, but well, there are a couple of holdings within your current portfolio which have the potential to generate significant income in the form of dividends and royalty income, right? So you've mentioned Cemos, we've discussed Futura, right? You also have Bilboes Gold. So maybe you can also discuss some details around that.
Yeah, with pleasure. I didn't cover really in my introduction that, again, one of the things that differentiates the trust is that we will always look to invest using a structure. So a typical model for us is a convertible investment that we will write ourselves, where we'll also have either a royalty, that we can acquire a royalty on the assets of the company that we're investing in, or we have an option to acquire a royalty. So we have a number of royalties in the portfolio as well. Futura, which I spoke about, not only do we have a significant equity position, but we have a 1.5% revenue royalty on Futura's coal production. So that will start. They're breaking ground this month at Wilton. So hopefully we'll start to receive a royalty check, I should say, from Futura in the first half of next year, and that could be quite material for the trust. And if you look at the forward curve for prices, we look out to 2025, as I mentioned, the first full year of production at Futura, then that royalty could be worth 46 million Australian dollars to the trust. We also have a royalty on a silver asset, which is coming into production next year. That has the potential to deliver $1 to $2 million a year for the trust. And we have a third royalty, which is a gold royalty on a project in the largest new gold project in Zimbabwe called Bilboes. We have a 1% royalty on that asset, and that's owned by Caledonia Mining, which is listed in London and New York. And that asset will be producing, or will produce, something around about 150,000 to possibly 200,000 ounces a year. So once in production, that could also generate a couple of $1 million a year for the trust. So those are the royalties. And then in terms of potential dividend income, I talked about the EBITDA potential from Futura and the increase in EBITDA from Cemos. So once those capital programs are out the way from both of those companies, so let's say 2025, we could see a dividend potential of around 10 million Australian from Futura per year to the trust, and something like 3 to 5 million euros from Cemos. So adding all of that together, and I obviously have to caution that this is very much forward looking, but it's illustrative. We could be looking at annual income of north of £10 million a year for the trust, in 25, 26. And that compares with the current market cap of about £38 million. So it's a material direction of travel for the trust, and the portfolio has matured, and we're quite close now within touching distance of getting royalty income, and not too far off getting some dividend income. So I think that will be a very important driver for the trust.
Trevor Steel, Managing Partner and CIO at Baker Steel Capital Managers. Thank you very much for your time.
It's my pleasure. Thank you.